Hello everyone, welcome to PwC Tax Bite podcast series. In this podcast, we're going to dive into the administrative guidance which was very recently published by the OECD on Pillar 2. My name is Pieter de Ree and I'm happy to be your host here today for this podcast. And I've brought with me a couple of colleagues from our Pillar 2 expert team here in PwC Belgium to comment on this administrative guidance. And first of all, I have Evie Geerts. Evie is an international tax expert, lots of experience, also with the US and the link between Pillar 2 and US. We have Joni Gekire. Joni was working very hard on tax technology and linked with Pillar 2. And Maxime Allard, who is an expert in the tax accounting aspects of Pillar 2. So I think with these people in my recording studio, I have some interesting experts to talk about the administrative guidance. Now, it has been long awaited. Before Christmas, we got a few bits and pieces, but finally, after many months, the OECD published the administrative guidance. So my first question is actually, and Joni, perhaps you can help me with that. What is actually in the administrative guidance today?
Yes, good morning, Peter. Indeed, the administrative guidance actually covers the most urgent questions that were asked by the businesses and by other stakeholders. And they bundled their answers in 111 pages, and they covered 26 items. They divided that in 5 different chapters. They covered some questions on scoping, also on income and taxes. There is a chapter on application of globe rules for insurance companies, some additional information on the transition rules, and then also some ideas on the qualified domestic minimum top-up tax.
Okay, yeah, thanks, Joni. I think the idea of the OECD is that, I think they clearly say this guidance will be included in a new update of the commentary later this year. So they want to create one central point of guidance. And they also indicate, I think, that, they will continue to work on additional guidance if certain issues come along during the implementation of Pillar 2. So that's good to know. But okay, almost 120 pages. There's a lot in there. In terms of scoping, Joni, is that long-weighted, that guidance? Is it a lot of useful guidance we have now?
Yes, indeed, Peter. There is some very welcome additional clarification in there, especially for other currencies, where they implemented a kind of streamlined way to change the euro thresholds that are in the globe rules to another currency like US dollar, for example. There are also some examples in there on investment entities and the interaction of the relevant accounting rule for consolidation and the globe rules, and as well some very welcome additional clarifications on the excluded entities definition, which will be useful for a lot of our clients, I think.
Yeah, indeed. Thanks, Joni. And yeah, indeed, for some groups have not a straightforward legal structure. And then indeed, I think the examples which are included will be very helpful. And what I also found very interesting is that there's now a full chapter on the qualified domestic top-up tax. So, Evie, I think this is the first time that we have guidance on this topic, huh?
Yes, Peter, and I think it's very welcome guidance, because this is obviously something we didn't have a lot of details on. And also Europe is quite clear that they are going to allow a qualified domestic top-up taxation, and I assume many territories within Europe will look into applying that option. Now, what do we know, or what is important as key takeaways? It is kind of the first step of your computation. So it comes before everything else, basically, in a nutshell. Obviously, there are some exceptions, but you will first determine at the level of the jurisdiction, and then, very similar to the globe rules, compute your domestic top-up taxation. What is important to keep in mind is that although obviously the mechanics of the globe rules will apply here, there is a bit of leeway or some degree of customization possible to the qualified domestic top-up taxation for each individual jurisdiction. So they will have the opportunity to tweak it a little bit to make it fit with their local tax legislation. So again, good that we have that additional guidance, but we need to monitor local implementation, as the rules also say that with that customization, even if there are slight deviations and a greater incremental tax liability occurs, the taxation could still qualify as a domestic top-up taxation under the GLOBE rules. Another one important to note is that you will also need to do a separate return for this. So yet another layer of complexity when it comes to compliance. So overall, I would say, Peter, very welcome additional guidance on the qualified domestic top-up taxation, but still a bit of leeway for territories or jurisdictions to implement this, and another layer of administrative compliance burden to apply in this respect. That was it a little bit on the qualified domestic top-up taxation. Maybe one to add is that I understand that they will also look into how this will fit into the safe harbor rules that were issued earlier in December.
Yeah, thanks, Evie. And linking to your experience with the US and GILTI, I think also that is an important topic throughout this guidance.
Yeah, and it's indeed also maybe a little bit linked to that qualified domestic top-up taxation, but I'll come to that in a minute. The other thing indeed that is very welcome is the confirmation that how GILTI will be treated in the framework of the Pillar 2 rules. As you know, GILTI is not a qualifying income inclusion rule, and it has now been confirmed that GILTI will qualify as a blended CFC tax regime, so a CFC regime under the Pillar 2 rules. They qualified as a general rule for similar systems, but throughout the text, you will see that they clearly refer to GILTI and also the GILTI rate. So it is something that was obviously put in place with GILTI in mind. So what is the complexity with GILTI? As you all know, it's computed on a global basis, not a jurisdictional basis. That is also one of the reasons why it's not a qualifying income inclusion rule. And the difficulty has always been how you then allocate the GILTI taxation to the different jurisdictions that it's applied to, as it's a global calculation and it's not attributable one-on-one to an entity or a jurisdiction. So there is guidance in the document on how you do that allocation. In a nutshell, you would allocate based on the jurisdictions with the lowest ETR. So basically, a portion of GILTI in the end would probably end up with the jurisdictions with the lowest ETR anyway. But, and I think that is a very important one for our clients, Belgian and European headquarters that have US groups in their group with non-US participations. The qualified domestic top-up taxation, as I said, is a first step. So GILTI allocation will only happen afterwards. So also in that framework, it will be yet another complexity to see how that qualified domestic top-up tax is credited or foreseen in the GILTI rules, and how that then flows up in the income inclusion rule at the level of the parent entity. Another important one to keep in mind is that the rules for GILTI or for the blended CFC tax regimes are only transitional rules, so they would apply for the first years under the Pillar 2 rules, and we will need to see what happens afterwards.
Yeah, I think that's particularly interesting, what you just explained, Evie. So if you think that through from a compliance timing perspective, it will be extremely difficult, I think, for groups to, first file the qualified domestic top-up tax return. That tax should then be taken into account probably by the CFC regimes that are applied throughout the group. And then afterwards, your income inclusion rule will again take into account the outcome and allocation of the CFC charges. This is, I think, a very good example of the complexity we will face. Now, another topic that often comes back is the famous provision 4.1.5. And for those who are not able to know the rules by heart, that's a provision basically that forces top-up tax in situations where you create excess tax assets. And Maxime, let me ask you here, does the guidance solve this issue? And perhaps you can explain briefly the issue first.
Sure, Peter. Yes, indeed. In the administrative guidance, we have received additional information on how to handle those situations. And to take a step back, as you mentioned, you have actually two specific situations that can happen. First, the one covered by 4.1.5. So that's a situation indeed where you have a group loss, and you have as well a negative adjusted covered taxes amount due to the fact that you are creating a deferred tax asset. To the extent that the negative adjusted covered taxes are less than 15% of the group loss, then you have in practice an additional top-up tax which needs to be paid according to 4.1.5. Second situation is the automatic, I would say, application of Article 5.2.1. That's a situation where you would have, in practice, a negative globe ETR. So an ETR for Pillar 2 purposes, which is negative, then it would mean that you would have, in principle, a top-up tax which could be higher than 15%. So the concept introduced in the administrative guidance, is the concept of excess negative tax expense carried forward. That's something new, which is basically a globe attribute for the M&E group, which can be used. And in practice, how does it work? It works as such that you do not need to pay that additional top-up tax. For example, the additional top-up tax related to 4.1.5, you do not have an additional cash out directly, but that is an attribute, which means that you will need to carry forward that amount to the next year or the years after as well, and then to deduct that amount from the adjusted covered taxes in the future, which will impact, of course, your Pillar 2 ETR in the future. What is interesting is that procedure is actually elective for Article 4.1.5, so this is optional. It can be applied. For what relates to the automatic application, I would say, of Article 5.2.1, this is, on the contrary, mandatory, which means that this system needs to be applied in practice. So all in all, I would say that the administrative guidance are giving interesting insights, but of course, again, they are adding complexity on complexity on that matter.
Yeah, thanks, Maxime. Yeah, I think to summarize, I think it's good that the option is foreseen. I think if you are confronted with top-up taxes that you would need to pay while building up tax assets of which you are not certain that you will effectively use them, then this option is, I think, a useful add-on, but it adds indeed another layer of complexity. It seems to be a bit the red wire throughout our discussion here, that the guidance is very welcome, clarifies a lot, but on some point seems to not solve certain complexity. And I think that is the same, if I may be honest, also with the chapter on transition, on the transition rules. So the audience probably knows that there are specific rules on the transition, meaning that if you transfer, for instance, an asset within the group after November 21 and before the Pillar 2 kicks in, that there are specific rules that aim to avoid that you create a step up on that asset transfer and a depreciation, which would then have an impact throughout the Pillar 2 calculations in later years. So there is a specific rule on that. And on the one hand, the guidance confirms this. And so if you, in a basic case, you would transfer an asset from a country with a 0% corporate tax rate to a country with a 20% corporate tax rate, while the guidance is confirming that the step up you create will be disallowed for Pillar 2 purposes. Now, there was a lot of concern on this rule, obviously, for double taxation, because there can be, genuine asset transfers within the group for which, if no step up is granted, you create an effective double taxation under Pillar 2. And here, the guidance is providing a lot of examples to clarify this point. trying to solve partially this issue of double non-taxation. And it comes down to the fact that if you transfer an asset in the transition period, based on this guidance, you could claim a step up to 15% in the country that acquires the asset, as long as there has been taxation in the country where the asset is being divested from. At least taxation at 15%, or if lower, your step up will also only be recognized for the lower percentage. I think, again, complexity, because it will require all of us to trace back all asset transfers that happened since November 21 until the Pillar 2 rules kick in, to make an analysis of whether you get a step up under Pillar 2 and for which amount you get the step up. So I think, again, very useful that there is additional guidance. It helps, I think, in a number of situations where there was a risk on double taxation, but it adds quite a bit of complexity, and we will still need to digest a lot of this in the coming days. Perhaps, Maxime, although we touch now on most of the aspects of the guidance, but I have also seen some developments next to this administrative guidance from the FASB. Is that perhaps also something you can briefly mention something on in this call?
Of course, Peter. Yes, indeed. On the 1st of February, so 2 days ago, the FASB has published a document further to a meeting they had, and the purpose was to discuss actually Pillar 2. And then they concluded that Pillar 2 could be considered as an alternative minimum tax for US GAAP purposes. And as well, they concluded that deferred taxes didn't need to be recorded for differences between US GAAP and the globe tax base, I would say, which is interesting because totally in line with what has been published until now from an IFRS point of view. But the only difference so far is related to the fact that the disclosures have not been tackled. So there is no comment from the FASB on the disclosure requirements for Pillar 2 purposes, at least so far.
Okay, thank you, Maxime, for that. I think, this was a pretty good summary, I think, of what is in the guidance, which was published very recently. Obviously, we will need much more time to digest all of this and come back to you either in this podcast or in another way with further insights. I think it shows that Pillar 2 is definitely moving forward now. And with this guidance, I think we can solve quite a bit of the uncertainties that were on the table beforehand. So with that, I would like to thank everyone for tuning in to this podcast, and also my speakers, of course, Joni, Maxime, and Evie, for their time to share this with you today. Thank you. Have a great day.